January 2026 is officially behind us, and the market did not disappoint. Some stocks absolutely crushed it, smashed our targets, and rewarded traders who stayed patient, while others pulled back hard, even crashed, creating once again massive discounted buying opportunities for traders who know exactly what to look for. But the real question is this: which stocks are still worth buying in February, and which ones are about to make their next major move? In today's video, like I always do, we are breaking down the best stocks to buy in February, based strictly on what actually worked in January, using real price action, real levels, and real trading logic. We'll cover what worked, what didn't, and most importantly, what to expect next as we move into February. Every stock on this list is a consistent big dollar mover, averaging over $3 per day, with strong volume in the last 30 days. These are stocks institutions actively trade, not random penny plays. And also, this is also a monthly follow-up to our January review, with new stocks added based on fresh momentum and changing market conditions. So whether you're a day trader, swing trader, or medium-term investor, this video is built for you. Now let's get into it. If you trade stocks, make sure you watch till the end because one setup here could surprise a lot of traders in February. Let's start with IREN Limited, ticker symbol IREN. This is a new addition to this month's list, and it's currently trading around $42.62 in after-hour session. In January, IREN clearly established itself as a momentum leader. From December into early January, the stock held a critical support zone after a period of consolidation. Throughout January, price respected this area perfectly. Buyers consistently defended higher lows, pullbacks stayed shallow, and volume expanded as price moved to the upside. And that's exactly what you want to see in a strong stock. What worked best in January was buying pullbacks into structure, not chasing upside. Every dip into prior resistance, which flipped into support, attracted buyers. So volume expanded on rallies, higher lows kept forming, and price pushed nearly 68% higher before pulling back. This was a textbook continuation setup. Heading into February, price has now pulled back more than 55%, breaking below the trend line and various key support zones. So the big question becomes, is this a deep buying opportunity or a warning sign? Clearly, you can see it was rejected at this support zone and bounced back up, increasing by 50% already. IREN stays on this month's watch list because of strong volume behavior, clean technical structure, and repeatable setups. So for day traders, on the 5-minute chart, the focus should be on VWAP and short-term moving averages. IREN works best on VWAP pullbacks during trend days with strong volume confirmation. Low volume means standing aside. For swing traders, use the daily or 4-hour or 2-hour time frame. The edge comes from retests of prior breakout zones. As long as price holds above key structure, pullbacks offer favorable risk to reward entries. And for 1 to 3 months investors, the weekly chart shows a trend reversing structure. Lower highs and lower lows keep the buyers bearish. A clean break above resistance invalidates these buyers and signals a trend shift. Dips offer buying opportunities, so watch out for pullbacks into demand zones for entries in an uptrend, with targets near recent swing highs. So next up is CRWV, one of January's most explosive momentum plays. CRWV, with ticker symbol CRWV, is currently trading at $90 after hours. From late December into early January, CRWV compressed into a tight range, then delivered a clean volatility expansion. This was a classic momentum setup, and once it broke out with volume, price expanded aggressively before pulling back. What worked here was waiting for confirmation. then trading continuation, not guessing. Traders who respected structure and managed risk were rewarded with this upside move. CRWV shines on momentum days, especially with high volume breakouts and continuation patterns. And so it stays on this list because volatility plus volume creates opportunity when managed properly. Now, moving into February, this is no longer about initial breakout. It's about buyers shift and structure holding. Price pulled back, breaking below the January breakout zone, and has now bounced off support, moving back to the upside, hitting previous resistance. Like I would always say, support zones are ideal entry levels. This is where the bind the dip strategy comes into play. So watch out for how price reacts here. Wait for a break and retest with volume confirmation for clean moves to the upside. No volume means no trade. A rejection here will mean a continuation downwards. Remember, false breakouts are real, and so tight risk control is critical. Targets remain near prior highs with stops defined below structure. If price loses this level, step aside. Now let's shift into the tech heavyweights, starting with Micron Technologies. Micron Technology, with ticker symbol MU, is currently trading around $394.69. From December into January, MU showed strong structure, respecting higher time frame support and moving in sync with the broader semiconductor sector. Each pullback was met with buyers, so there was no panic selling and no structural breakdown. What worked was buying dips into demand, especially when the semiconductor sector confirmed strength. Institutional participation was clear, and that fueled the strong upside move into all-time highs at 457. However, as expected, heavy profit taking followed. Price sold off sharply, dropping back into prior resistance turned support. Now, heading into February, the sell-off has continued. MU has now broken weekly demand, signaling a shift in buyers. This move aligns with the broader market weakness affecting tech, metals, crypto, and risk assets generally. MU remains on the watch list because of its deep liquidity and semiconductor leadership, making it a core name to monitor as market conditions evolve. So for day traders, VWAP reactions and intraday demand zones remain the edge, but confirmation is key. For swing traders, watch reactions near daily support zones. Clean bounces offer defined risk. Weak reactions suggest staying out of trade. And for 1 to 3 months investors, if the weekly structure breaks, it shifts the buyers to neutral and to cautious. So it's best to stay aligned with the broader trend and wait for confirmation. Next up is a trader favorite, Palantir. Palantir Technologies, ticker symbol PLTR, is currently trading around $135.90. So from our December review, Palantir respected its support zone and range structure into January. Early January was defined by tight consolidation. That was a sign of strength, not weakness. And what worked here was patience. Traders who waited for structure avoided unnecessary losses. Later in January, Palantir broke below key support and continued lower towards zones we've highlighted since August 2025. Coming into February, price has seen heavy selling, pushing it towards the 125 area. Palantir stays on the watch list because institutions are still active here and its liquidity creates repeatable trading opportunities. So February is a decision month for Palantir. For traders who day trade, focus on continuation of reversal signals at key levels. For swing traders, wait for clean acceptance above resistance before committing capital. And for 1 to 3 months investors, structure is already weakened. Accumulation should be strategic and only at strong demand zones. A move below 118 zone signals increased risk and caution. Now, let's pivot to two of the biggest tech movers, AMD and Tesla. Advanced Micro Devices, ticker symbol AMD, is currently trading around $207.79 as at today. AMD entered January aligned with the broader semiconductor trend, respecting demand and holding structure. Breakout retests provided clean opportunities, shooting price up to its high before price eventually pulled back. Heading into February, AMD has sold off sharply. It went down nearly 30% from its January highs, breaking key structure. This signals a change in buyers as the broader market weakens. If price reclaims resistance with strong volume, that signals a potential trend shift. AMD stays on the watch list because of its consistent volume and sector relevance. So if you are day trading AMD, focus on trend pullbacks and avoid choppy conditions. For swing traders, only engage if structure rebuilds. And for 1 to 3 months investors, demand zones remain key areas for accumulation, using dollar cost averaging where appropriate. Now buckle up, let's talk Tesla. Tesla, ticker symbol TSLA, is currently trading around $411.11. Tesla remains one of the most actively traded stocks in the market. Tesla remained highly volatile throughout January, respecting range boundaries rather than trending cleanly. What worked was trading with the range, not predicting breakouts. Strong intraday moves rewarded disciplined traders who respected structure. Now, coming into February, Tesla broke below range support and headed towards the 380 support zone. The key question is, does price stabilize here and rebound, or does this breakdown extend lower? Well, as we can see, Tesla rebounded and reversed back upwards around 387. So we'll be looking out for a breakout with volume above resistance for a continuation to the upside. Tesla stays on the watch list because volatility plus liquidity equals opportunity when traded with discipline. So for day traders, VWAP reactions and momentum breakouts remain high probability plays. For swing traders, only trade confirmed expansion. And for 1 to 3 months investors, well, on the weekly chart, bias is shifting bearish unless structure reclaims key levels. Confirmation is everything. And finally, the king of AI stocks, NVDA. NVIDIA, ticker symbol NVDA, is currently trading around $185.41. NVIDIA led the market throughout January, consistently defending higher timeframe demand and printing new highs. Pullbacks were rejected aggressively, confirming strong institutional control, which worked for NVIDIA. Early February brought a broader tech sell-off, and NVIDIA pulled back over 12% from its high in January, breaking initial support and hitting the next demand zone before bouncing off and reversing back upwards. It has even broken above prior resistance and heading towards the January highs. If you missed buying at the demand zone, the next ideal entry will be at the retest of the prior resistance turned new support. NVIDIA remains on the watch list due to its liquidity, leadership, and institutional flow. So for day traders, intraday trend pullbacks into demand zones offer clean entries. For swing traders, watch reactions as support or continuation above recent highs. And for 1 to 3 months investors, the trend remains bullish unless weekly structure breaks. So here's the key takeaway. January showed us who the leaders are. February is about patience, discipline, and execution, not chasing green candles. The best traders react to structure. They don't predict. Focus on continuation, reversals, pullbacks into value zones, and confirmed breakouts. The market may be shifting, so risk management is non-negotiable. If you found value in this monthly stock review, hit the like button, subscribe for weekly and monthly market breakdowns, and drop a comment telling me which stock you're watching in February. Good luck and trade smart, and I'll see you in the next video.